Investors in Facebook who lost money because of technical problems when the company was floated last month are being offered $40 million in compensation by the Nasdaq Stock Exchange. The share launch was marred by computer errors, which left institutional investors unsure whether their transactions had gone through successfully or not. Well, to get more on this, let's speak to our Washington correspondent, Steve Kingston. And Steve, Facebook hasn't had much luck with its flotation.
No, this was viewed as a botched and pretty disastrous flotation. Remember, Facebook's price now, just over 2.5 weeks since that flotation, is down a third on what it was on the day itself, a Friday morning last month. And this really is an attempt by the Nasdaq, the stock exchange that was responsible for that flotation, together with Morgan Stanley, the big bank that underwrote the flotation. It's an attempt to really deal with the aftermath of that mess, frankly, because in the first couple of hours of trading on that Friday morning, first of all, there was a delay in the shares going live. And then secondly, people who were trying to buy and sell Facebook shares were unable to see whether the trades had gone through because of a glitch in the computer software system. And so what the Nasdaq's bosses are doing now is essentially offering $40 million in compensation to what are called market makers. These are not ordinary shareholders. These are big institutional investors, bankers, banks, brokerages, people who really make the wheels of the stock exchange turn for the Nasdaq. They're being offered $40 million, although some of them say that their losses exceeded that greatly.
But Steve, not everyone is happy with Nasdaq's decision.
No, that's right. Some of those market makers are saying they lost a lot of money. The biggest four brokerages and banks say that they lost $115 million, so a lot more than $40 million on offer. And then beyond that, you have rival exchanges like the New York Stock Exchange saying that this is just simply not going to work, that it's anti-competitive, because what the Nasdaq is doing, in addition to offering cash, is offering credit for future trades on its exchange. So the New York Stock Exchange looks at that and says, well, the Nasdaq has messed up here, and yet it's using this compensation package to try and create more business for itself in future. Ultimately, it's the Securities and Exchange Commission, the regulator of stock markets here, that will decide whether this compensation package goes through.
Steve Kingston from Washington with the latest on that. Thanks very much.